All right, so I've been through this before. What if I told you there was a way to get savings account characteristics with higher average long-term returns than the rates that the banks are paying you now? I really want you to think about something that fits in between a bond and an equity, kind of right in between that space. So we've been through this part before where we talk about the characteristics and the important considerations of the savings account and using cash value life insurance as the savings account. And we've been through tax deferred growth, tax-free distributions, competitive returns, high contributions, the other features and benefits that it can provide for you, collateral opportunities, safe, no loss, guaranteed loan, all that stuff. But today I want to focus on competitive return. Let's talk about competitive return in this video. Let's start with, we can do the S&P 500, we can do the Dow Jones, we can do the Russell 2000, we can do the NASDAQ composite, government muni bonds. And what I want to do is I want to start with the S&P 500 total returns, which includes the growth or the appreciation of the stock prices in the S&P 500 plus the dividends. And we're going to go back to, it's been around for 88 years since 1936, but let's go all the way around to the year 2000, because that's really the most recent decade that we started with some negative returns through the end of 2023. So that's a 24-year window of time. And so to set this screen up, what you're looking at is here under the actual column, you have the average rate of return over a period of time, this 24 years. And that includes -9% in the year 2000, -11, -22. You guys remember that? That's when I started in the year 2000. 28, 10, 4, 15, 5. We thought the market was coming back. Everything's great. And then boom, -37%, +26. And in fact, if I show you 2000 through 2009, that period of time, that's called the lost decade. And the reason why that's called the lost decade is because if you were strong enough to remain invested for that period of time, it's one of the only decades, any one of the 10-year cycles that exist, whenever you pick a 10-year window where the market actually had a negative return. -0.95% was the actual rate of return over that period of time. So it's called the lost decade. A dollar invested in the year 2000 would have been worth 91 cents at the end of the year 2009, the lost decade. So we're going to go 2000 through the end of 2023. We're going to compare the S&P 500 total return index, which is price appreciation plus dividends. And we're going to compare it to an alternative that you would find in a cash value life insurance plan using indexed interest crediting as an option for you. And we have other videos that talk about the fees and expenses, the policy charges compared to a traditional brokerage account, which please dig into that. In fact, I'll put a link to that one right here. But for today's conversation this is the competitive return portion of the characteristics of a good savings account. Because I did the video not too long ago about should you pay cash or should you finance your house? And a lot of the comments were like, but yeah, where can you get an interest or where can you get a savings account that's paying more than the cost of borrowing the money? Because at the banks, they don't make money if the deposit accounts are more than the loans. They make money when the loans are charging more than the deposit account. So we need a savings account that can provide a better interest rate crediting than what the banks will provide you. Okay, so here we go, setting this thing up. And so here where it says optional limits, and there's different features and benefits. So what we're going to do for a particular type of structure is we're going to exclude the dividends because it's going to be just the S&P 500 price. And then we're going to put a floor. In all of these products that have a savings account feature to it, there is a guaranteed floor of 0%, meaning that you don't experience any downside when stock markets fall. The interest does not go negative. But on the upside, you don't get all the upside. And that can be either a cap, which means it hits a ceiling. It can be a participation rate, which means you only participate a percentage of the growth, 70%, 60%, 80%, or a spread, meaning a hurdle to jump over, 5, 7, 8. Unfortunately, some companies have 10, but what's that hurdle to jump over before you get unlimited gains? And we can go through these, but for right now, let's just say that I have a product with a 10% cap, which is pretty fair for what's out there right now, a 0% floor, 100% participation. And I said, we're looking for a savings account that is between a bond and an equity that fits in that space right there. I'm not looking to compete necessarily with the equity markets. I'm looking to outperform what I would get traditionally at a bank, savings account, CD, money market, credit union. That's what I'm trying to be. And so look at this. You have annual returns over here, which is the unrestrained S&P 500 over that period of time, 2000 through the end of 2023. But at the same time, I have the limited return, which is the comparison. Now think about this. When the market was down -9, there's a 0% crediting. You don't make any money, you don't lose any money. And this is not correspondent to any fees, expenses, and charges. That's where product design and making sure you have the smallest death benefit possible to minimize the policy charges, fees, and expenses. So for all of you out there that you're going to try to talk to me about, yeah, but what about the fees and expenses? That's not this conversation, because when we design it the right way. Minimum death benefit, maximum cash value. We'll blend some term in there. We will make this thing as cost effective as possible for the features and benefits that we're trying to get. So we can have a conversation on that another time. So don't come to me with, oh yeah, but it's an expensive product. When designed properly, my design will be cheaper than your 1% management fee of you managing this, but I digress, okay? So look at when the markets are negative, in like 2000, 2001, 2002, -9, 11, 20, this is a 0% return. But on the other side, when the market hits the high home run, 28%, my example with the cap of 10, we hit a cap, 10, 8, 4, 3, 15, 10, 5, 3. And remember, it's because we're comparing against the S&P 500, including dividends, and I'm excluding the dividends on the comparison account. But over that period of time, you would have had an actual rate of return using a 0% to 10% range of 5.94%, almost a 6% savings rate. Pretty darn good. And by the way, if I go back to that lost decade as a comparison, check this out, where the actual stock market, the S&P 500 total return price and dividends had a lost decade where $1 became worth 91 cents. Using this 0 to 10% range, you actually would have had 4.46% return, meaning $1 would have been worth $1.55 at the end of that 10-year decade. And remember what was happening with interest rates in the years 2000. Interest rates were being driven down, right, to make sure that they could address the economic issue of the stock bubble bursting. So that's where interest rates were erased to 0%, and banks were not paying you 4% on average during that period of time. But that's the power of this type of vehicle when we properly set it up and structure it. And then the key is finding a carrier. If we change the cap to 12% instead of 10%, look at what happens. I'll go back and do it again. A 10% cap gave us a 5.94%. If we're able to find a carrier that gives us a 12% cap, it goes from 5.94 to 6.8. A dollar turns into $4.93 as opposed to $4.40. Like it all makes a difference. Or if, let's say I go over here and I have something that has an 8% hurdle or an 8% spread over that period of time, meaning I don't get any interest paid to me for the first 8%, but everything over that in that year, if it performs higher than that, then I'll get a higher return. And that's 6.1% compared to the stock market return. And again, if I go back to the lost decade as a comparison, where we use a spread of 8%, not a cap of 10, but I don't have to take all the bad with all the good. I still get a 3.8% average return as opposed to a negative 0.95%. So there are different vehicles, and there are also different indexes that could be used in this type of account as well. So there are companies out there that use the NASDAQ 100. I know this is going to say the NASDAQ composite. They're similar. They're not the same. The NASDAQ 100 actually performs better than the NASDAQ composite over a period of time. But to give you an idea, if you had a product that had a NASDAQ index with a 10% hurdle during the same period of time, where the NASDAQ itself, all the good, all the bad from 2000 to 2023 had an actual return of 5.59%, putting a floor of 0, a hurdle of 10 to jump over. So you get everything over 10. It has a 9.21% average return. And remember, in between a bond and in between an equity is where we're getting the characteristics of the savings account. This is a savings account alternative. This is not an equity alternative. But how would you like to get this type of interest crediting in your savings account? Better than what the bank is paying you, right? So I'll go back over here, 0% floor, 12% cap, 0% floor, 10% cap, or wherever the cap is for that carrier. And that's where you need to have a competent a financial advisor that's not ignorant, that's not lazy, that's not greedy, that can design this for you the right way. You can find a savings account that gives you better than bank interest paying for you, while it allows you to borrow money. And go back to my last video, how would you like to pay for it? Would you like to pay cash? Would you like to finance it? When I use 5% and 5%, it's the same numbers for everybody. But what I'm talking about here is how can we get that arbitrage? How can we get a higher interest crediting compared to a lower cost of borrowing? Now we're starting to talk about a strategy that makes sense. Now we're starting to put real money at work and building your own bank for you. So I hope this has been helpful. If you have any questions, comments, things that you want to say, make sure you like, comment, share, subscribe. Go back, check out some of the old videos. We got some really good content. We got more content coming out. I'll see you in the next video.